There is a conversation that happens every day in bank branches across this country, and it goes something like this. A person walks in, 52, 58, 63 years old, and sits across from an advisor who works for the institution. They explain their situation. They describe their savings, their concerns, their hopes for the years ahead. And the advisor, with genuine warmth and professional competence, recommends a selection of products that the bank offers. Products that generate fees for the bank. Products that are designed at the structural level to keep the customer's money inside the institution for as long as possible, and to extract the maximum sustainable return from it over that time. This is not a conspiracy. Nobody in that branch is lying to you. The advisor believes in what they are recommending. The products are legal and in many cases reasonable. But there is a profound difference between advice that is designed to serve your interests and advice that is designed to serve the interests of the institution you are sitting inside. And most people in that conversation never stop to ask which one they are receiving. My name is Richard Harlow. I have spent more than 4 decades on the other side of that conversation, not inside an institution, but independent of one. And the single most consistent thing I have observed over those 40 years is this. The people who build the most durable financial security in their 50s and 60s are almost never the ones who followed the standard institutional path. They are the ones who understood, at some point, how the institutional model actually works, what it is designed to do, what it costs, and what alternatives exist that the institution has no incentive to tell you about. What I want to share with you today is not a secret in the dramatic sense. Nothing I am going to describe is hidden or illegal or accessible only to the very wealthy. But it is information that the standard banking and financial services model has no structural incentive to put in front of you. And the absence of that information, the simple, practical, entirely learnable understanding of how money can work outside the institutional framework, is, in my experience, one of the most significant financial disadvantages faced by people over 50 who are trying to build genuine security. Let me take you back to 1994. I was working independently at the time, and a client named Robert came to me after 23 years of what he described as responsible banking. He was 57. He had a significant amount of money sitting in a portfolio of products his bank had assembled for him over 2 decades. A mix of savings instruments, managed funds, and insurance products that the bank had recommended at various points in his life. He had trusted the institution. He had never looked carefully at the fees. He had assumed, reasonably, that an institution he had used for 23 years was working in his interest. When we sat down and actually examined what Robert had, what each product was costing, what each one was returning, and what the net real outcome was after fees and inflation, Robert went through several stages of reaction over the course of about 2 hours. First confusion, then disbelief, then something quieter and harder to name. He had paid, over 23 years, a sum in management fees and product costs that was not trivial. It was the kind of number that, if he had understood it at the outset, might have led him to make different choices. Not because anyone had deceived him, but because the institution had never had any incentive to make the full cost structure visible. This is the first thing banks do not want you to know, and it is the most important. The cost of financial products is almost never presented in a way that allows you to understand the actual long-term impact on your wealth. Management fees, fund expense ratios, insurance product charges, advisory fees that are expressed as small percentages rather than large dollar amounts. All of these are real costs that compound against you over time, just as surely as investment returns compound for you. A 1% annual management fee on a significant portfolio, paid consistently over 20 years, is not a small cost. It is a life-changing cost, expressed in units of financial security you do not have at the end of the period that you would have had if the same money had been working inside a lower-cost structure. Robert, once he understood this, asked me the question I have been asked more times than I can count in the years since. He said, "What should I have been doing instead?" The answer is not simple in its details, but it is simple in its principle. The principle is this. The most powerful wealth-building tool available to someone over 50 is not a product that a bank sells. It is the compound effect of keeping more of your own returns by minimizing the friction between your capital and its growth. Every dollar in fees, in unnecessarily high costs, in product charges that exceed what simpler alternatives would cost. Every one of those dollars is a dollar that does not compound for you. And after 50, when you have perhaps 15 to 20 years of meaningful compounding left ahead of you, the cost of that friction is at its most expensive. The specific alternatives that banks have no incentive to describe vary by situation, and I am not going to pretend that a single conversation can replace a careful review of your individual circumstances. But the principle is universal, and the principle is this. Low-cost index funds have, over almost every meaningful time horizon, outperformed the majority of actively managed funds that charge significantly higher fees. This is not a controversial statement among serious financial analysts. It is one of the most consistently documented findings in the history of investment research. And yet the banking and financial services industry continues to sell actively managed products at high fees, because those fees are how the industry generates its revenue. This is not deception, it is business. But it is a business model that works, financially, by extracting value from your returns over time. And understanding that business model, seeing clearly what it costs and what the alternatives are, is the first step in the strategy that the institutional model has no incentive to put in front of you. The second thing that changed Robert's financial life over the years that followed was a shift in how he thought about debt. Not eliminating it, though eliminating high-cost consumer debt is always the right move, but understanding the difference between debt that extracts value from your life and debt that creates it. Banks are in the business of lending money at rates that exceed what they pay for it. That is their core economic model. And because it is their model, their incentive is always to have you borrowing at the highest rate they can charge and keeping the largest balance they can sustain. The credit card with the rewards program that encourages you to spend. The home equity line that makes it easy to access the value in your home for purposes that reduce that value over time. The personal loan that consolidates existing debt at a lower rate, but extends the repayment period so the total interest paid is actually higher. Each of these products is legal. Each of them makes reasonable sense in isolation. And each of them is structured to serve the institution's financial model before it serves yours. What Robert eventually understood, and what I watched transform his financial trajectory over the following decade, was that debt is not a monolithic category. Some debt, used deliberately and strategically, generates more value than it costs. A mortgage on a rental property that produces monthly income in excess of the carrying cost. A business loan that funds expansion generating returns significantly above the interest rate. A carefully structured line of credit used to smooth cash flow in a way that prevents more expensive short-term borrowing. These are not the products banks lead with. They lead with the products that generate the highest sustained revenue from the largest number of customers. The strategic uses of debt, the ones that work in your favor rather than the banks, require understanding that no standard banking conversation is going to provide. There is a third dimension to this that took me longer to understand, and it is in some ways the most important. Banks earn revenue from your passivity, from your inertia, from your reluctance to move, to renegotiate, to question the terms you accepted years ago when your situation was different. The savings account you opened at a branch 20 years ago, the mortgage rate you locked in during a period when you had less financial leverage than you have now. The insurance products whose terms were appropriate when your dependents were young and are no longer appropriate now. The investment products that made sense for a 35-year-old's risk profile and have never been adjusted for a 58-year-old's different relationship with time and risk. Every one of these represents a situation in which the institution benefits from your not acting, and in which a simple conversation or review could produce a meaningfully better outcome. I am not telling you that institutions are your enemies. I have sat inside enough of them to know that the people who work there are mostly doing their best within a structure they did not design. But I am telling you that the structure was designed to serve the institution, and that understanding that clearly, not cynically, not angrily, but clearly, is the foundation of every meaningful financial improvement available to someone over 50. Robert, 11 years after that first conversation, sat across from me one more time. He was 68. The changes he had made, not dramatic changes, not a wholesale reinvention of his financial life, but a series of specific, informed decisions about fees, about debt, about the terms of the products he held, had produced an outcome that genuinely surprised him. Not because anything he had done was clever or sophisticated, but because the compound effect of lower costs, better structured debt, and a regular habit of reviewing terms rather than accepting them passively had worked exactly the way compounding always works. Slowly, invisibly, and then all at once. He said something to me at the end of that conversation that I want to leave with you. He said, "None of this was complicated. What was complicated was finding out that the simple version existed, because nobody who was being paid to tell me had any reason to. That is the wealth strategy banks do not want you to know. Not a product, not a system. An orientation. The orientation of someone who understands the interests of the institution they are dealing with, who asks the questions those interests discourage, and who makes decisions based on their own financial reality rather than the product menu they have been offered. That orientation, applied consistently from this point forward, is worth more than any single investment decision you will ever make. Before you close this video, I want to ask you one thing. When did you last sit down and look honestly at what every financial product you hold is actually costing you? Not just in fees, but in the difference between what those products return and what lower-cost alternatives would have returned over the same period. Leave your answer in the comments. I read every one. And I think that question, taken seriously, might be the beginning of the most valuable financial conversation you have had in years.